Well, today's reversal comes as companies get ready to report second quarter earnings. Consensus is that 2Q will be the trough, but with reclosings mounting, is there actually more pain ahead? Julian Emanuel is the chief equity and derivative strategist at BTIG. Julian, great to have you with us.
Great to be with you.
Second quarter, even the conference calls, do you think we're going to get any answers? I mean, we had Pepsi report earnings better than expected. The stock was up for some time, but there was still no guidance on the rest of the year.
It's kind of naive for investors, and I know this has been a narrative of the last week or so, to expect firm guidance. I mean, simply, if you look at today, the California rollback, escalation of tensions with China, whether you're a domestic-oriented company or you're an exporter, and a lot of these technology companies have China exposure, it's just not going to happen. The uncertainty level, again, as reflected by the PIC, is telling us that there is a range of outcomes that is much wider than normal, and that clarity is something that's likely not to happen until we get more medical news or until we see how schools in particular reopen across the country.
I mentioned that consensus is that the second quarter will be the worst. Are you in that consensus, or do you think that there is still the possibility that we have not seen the worst when it comes to the decline in earnings?
No, we're in that consensus, but the difference is, and I think this goes to the heart of the discussion in terms of sectors and so on, is that, you look at something like the technology stocks, what they seem to be pricing in is a V-shaped recovery as opposed to the cyclicals and financials in particular, which are really pricing in a continuation of both an economic recession and an earnings recession, which we think the reality is somewhere in between.
Hey, Julian, it's Guy. Obviously, thanks for being here. Correct me if I'm wrong. Maybe you saw it, maybe you didn't. I think Goldman Sachs upgraded their earnings forecast for this year for the S&P 500 from 110, I believe, to 115. But they said, I think, 2022, they expect $170 of earnings. Is that, where do you come down, basically? Does 2021 matter? I think it does. But where do you see 2022 potential earnings?
Look, so the question is 2022 the year, and we would take exception to the 2021 number. We're at 152, and if you'll recall, 2019 was peak at 163. The question is, when do you return to peak? We expect that's likely in 2022. 2020 doesn't matter, but the real question is, again, what is the range of outcomes when thinking about 2021? And from our point of view, again, the longer the economy starts to sort of stutter and there are more shutdowns, the more that 2021 becomes an issue. We don't necessarily see less than two-sided risk either up or down here, but you could get that way depending on how reopening goes into the fall.
What's the risk reward to investing in the NASDAQ right now, Julian, given that we're only a couple % off from record highs?
Well, look, in the long term, and again, this is thinking out 12 months, we see new highs in the S&P 500, likely accompanied by the NASDAQ. But in the near term and the medium term, there's a lot of risk in the NASDAQ because, again, simply whether you measure it in terms of valuation difference or the concentration, we've all been talking about the FANG stocks, their representation, outsized in the S&P 500. There's probably a good 10% downside in the near term here, we think.
10% downside in the near term. All right, Julian, thank you. Always great to speak with you. Julian Emanuel of BTIG. Jeff Mills, can you see that 10% downside in the near term?
Sure. I mean, it's obviously hard to predict exactly what's going to happen, and the whole sector has obviously been a juggernaut. But at the same time, to my point earlier, you have such a concentration there where if you do get a hiccup and all of a sudden you get risk aversion associated with tech, you have further to fall. So I think that's really the key right now. And I'm not particularly a fan of value at the very moment, but if you look at the spread between value and growth from on a PE perspective, I mean, it's just ridiculous. You're talking about 98th, 99th percentile readings, whether you're talking about price to book, price to sales, price to earnings, whatever it is. So the gap there, and if all of a sudden investors aren't willing to speculate in tech, you could certainly see a 10% fall very easily.
All right, let's get to another test for the markets. Bank earnings in focus this week. JP Morgan, Citi, Wells Fargo kicking things off tomorrow. Morgan Stanley, Goldman Sachs, Bank of America on deck later in the week. Dividend announcements, credit risks, the impact of historically low interest rates are just a few key issues Wall Street will be looking for in these results. Guy, what are you going to be focusing on? You've been pretty clear that you don't particularly like the banks here, but you do like Wells.
Yeah, well, I mean, what I'm looking for a trade, yes. Obviously, loan loss provisions is number one on everybody's list. But what I want to hear, because then I can start to do the math, is tell me, assuming it's correct, tell me what your tangible book is, if you're a bank, and I'll tell you where I think the stock should go. And we played that out with J.P. Morgan when it was an $85 stock, and we tried to explain to people how at a $62 tangible book, if you gave them a 1.8, 1.85 multiple on that, you have a $115 stock. And if you look and saw where JP Morgan recently topped out at, it was exactly at 115. So what I'm looking for is loan loss provision 1, and tell me what your tangible book is 2. And with those two, I should be able to tell you where I think the stocks are going.
For a trade, Bonawyn, do you like any of the financials?
I do. Quite frankly, I would be looking at the large money center banks and the broker dealers. In addition to the points that Guy laid out, I'm also looking at trading and fee generation. Those are really going to be core tenets of those particular banks that we're not seeing in the regional space. So I like the money center banks, the large BDs, bulge brackets, vis-a-vis the regional banks. So XLF vis-a-vis KBW, for example.
All right. Carter Braxton Worth, our friend who recently joined Twitter, tweeted this morning, and I know you all caught this. Today we speculate on financials playing for a prospective bounce in a concomitant period of relative strength to SPX. We recommend XLF to express this view. Speaking of value, Jeff Mills, this has got to be it. Value sector du jour. Do you like this one, though?
So I read Carter's research, and I saw that report come out this morning, and I think for a trade, I don't necessarily disagree. Look, this is all about expectations, and for financials now, you're talking about lagging the broad market by 30 or 40%. You're trading at a 9 times PE ratio, and Carter made the point on the technicals. You're probing the relative lows that we made in 2009, just as an example. So I could certainly see a pop heading into earnings just because expectations are so poor. But longer term, I just think the rate environment is going to be such a headwind. And even though the Fed doesn't affect long-term rates as much as short-term rates, I think still you're going to have a hard time seeing a yield curve steepen. I was looking at the copper-gold ratio as an example. Typically, as that moves higher, which it has, you will see rates follow along. What has developed is this huge gap between that ratio and the 10-year Treasury as an example. So rates are just anchored even on the long end, and I think ultimately that's going to be tough for banks.
Not too many individuals can get concomitant into a tweet these days, so I applaud Carter Worth not only for his research, but also for his vocabulary.